let's talk about zesty ginger turmeric sweet potatoes. You mentioned them in your book, and you talk about the power of labels. You say, investing blindly or by labels only is the way investing is going today. More and more money flowing into more and more ETFs. It's industrial investing, like industrial farming. It doesn't have to taste like a real tomato. It just has to look like one so they can sell it to you. I mean, Chris, wow.
Thank you.
That's a good one.
Yeah. I mean, I think that's true. I mean, the zesty turmeric, what were they again? Carrots.
It was carrots or potatoes?
Yeah,
it was, I think
carrots or potato. One of the other, doesn't really matter. But the idea came from an experiment. There was involved a lot of people in a cafeteria, studied over a period of time where they experiment how they label the foods. And they, just put out simple and you call them carrots. And then they would play around with the label. And then they had them very descriptive one. And you could see that the way they label them would definitely have statistical significance in how people would choose it. They didn't change the actual carrots at all, just the label. So I was fascinated by that. And I think, a lot of life is like that. And you mentioned investing. That's why all these big investment houses create endless funds that with labels that are, whatever the hottest thing is.
It looks like a tomato. It doesn't have to taste like one. Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money, how to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, investor, and a founding partner of Sicard Associates, a boutique investment firm founded in New York City. Join me on this quest to unearth the wisdom of the ages. Welcome, everyone. I'm so glad you're tuning into my podcast. For your convenience, the show is available on a multitude of platforms, including Spotify, Apple, Google, Audible, and many more. If you want to keep up with all new episodes, and there's so many more in the queue, make sure you subscribe and please do share it with friends and family. Review it and rate it if you can. Every little gesture matters, and I thank you for it. If you'd like to know more about me, or if you're interested in getting in touch, simply Google my name and it will lead you straight to my website. There's a contact form there, or check notes to this episode for links. I love hearing how you listen to my podcast on your walks, hikes, alone times, drives, trips, and more. I trust that my guests and I are a wonderful company on those adventures. I also enjoy reading how some of you are rehearsing and answering some questions that I ask my guests. I love hearing that. If you're new to the show, please scroll down and check out all the amazing guests I've had over the last few months. If you are serious about investing, money wisdom, wealth, and living a better life, you'll find plenty of episodes with some incredible ideas. For those who enjoy reading thoughtful pieces, I regularly write articles on Substack, which I'm sure you'd find insightful. Find me there and follow me as well. Finally, I'd like to mention my latest book, Crisis Investing. It's a collection of 100 essays that I penned for our clients during the tumultuous times of the global COVID pandemic. These essays are both timely and timeless, providing a unique perspective on navigating through crises. They were never meant to be published, but here they are available to you. Please find the book on Amazon. The book has already received considerable recognition and much love, ranking among the top releases on Amazon in its initial weeks. Thank you for your support and for being a part of my listener community. Now, without further ado, let's dive into today's episode. I'm always excited to have Chris on the show. It's his second appearance, and we had so much fun, if not more, as last time. Christopher Mayer is the founder of Woodlock House Family Capital and author of several books, including 100 Beggars. Before starting Woodlock House, which went live in January 2019, Mayer worked with Bonner and Partners and the Bonner Family Office. He was the editor of Capital and Crisis, published by Agora Financial from 2004 to 2015. He was a corporate banker from 1994 to 2004 and graduated magna cum laude with a degree in finance from the University of Maryland. He also has an MBA from the same institution. He's the author of Invest Like a Dealmaker, Secrets of a Former Banking Insider, World Right Side Up, Investing Across 6 Continents, 100 Beggars, Stocks That Return 100 to 1 and How to Find Them, How Do You Know? A Guide to Thinking Clearly About Wall Street Investing and Life, Dear Fellow Timebinder, Letters on General Semantics. Today we focus on the last 2 books, How Do You Know? And The Dear Fellow Timebinder. Today we discuss Alfred Korzybski's concept of time binding and its implications for human learning. Chris emphasized understanding the limits of our knowledge as a form of wisdom. We explored tools for effective transmission and retention of knowledge. Chris talked about oversimplifying, cause and effect, and our tendency to use abstractions. We discussed the idea of structural differential and its importance in interpreting reality. Chris shared his perspective on how labels can influence investing decisions. We discussed thought-provoking ideas like 1 + 1 not always equaling 2 and the possibility of rewriting history. Chris introduced the concept of delayed reaction. We delved into the differences between facts and inferences. We discussed the need for a nuanced view of the world, moving beyond binary perspectives taught in school. We talked about the view of success, advocating for a more nuanced perspective. We discussed misguided certainty and the problem it can cause. Chris proposed Wendell Johnson's set of questions as a starting point for those new to general semantics. We left the best for last and concluded by discussing the illusion of contentment tied to wealth accumulation. Please help me welcome Chris Mayer. Well, hello, Chris. It's nice to see you again.
Nice to see you, Bogomil.
So this is your second time, and we're talking about...
Repeat offender.
We had a lot of fun talking about your investment book, 100 Beggars, and you wrote other books. And you say they're not about investing, but I think they are very much about investing, especially the two of them. So one is called Dear Fellow Timebinder, Letters on General Semantics, and the one a little bit earlier that you published, I think, 3-4 years ago, How Do You Know? A Guide to Clear Thinking About Wall Street Investing and Life.
Right.
And I really took my time reading them for the second time. As you know, I took a lot of notes and I have so many great quotes and I wrote down so many questions and I hope we get to all of them today. But I mentioned to you that you propose a vocabulary, for the lack of a better word, to interpret the world around us from a different angle. And I read a lot and there are very few books that make me pause and really think. And those 2 did. So I appreciate you writing them. So thank you.
Oh, very good. Appreciate that.
So let's jump in. In your books, you quote Alfred Korzybski, who wrote, "Human beings possess a remarkable capacity which is entirely peculiar to them. I mean the capacity to summarize, digest the labors and experiences of the past." How did you discover Alfred Korzybski, General Semantics, and what does it mean to be a time binder?
I discovered him reading the nonfiction works of Robert Anton Wilson. Does that name ring a bell at all? He wrote, he might be most famous for his fiction. He wrote a book called The Illuminatus Trilogy, I think. But the nonfiction books that I read, one was called Cosmic Trigger. Mm-hmm. That's probably his best, in my opinion. And he refers to Korzybski, a bunch of times in that book. That was the first time I had ever heard that name. Uh-huh. And he does it in other books as well. He mentions Korzybski in General Semantics. And then there's one speech I heard him give where he said he learned more from Korzybski than any other writer. And at that point, I was like, okay, on that, I gotta dig out more and learn more about this. So that's what set me on the path. Uh-huh. And so now that I know about Korzybski, he did influence a number of other people that I also like. Alan Watts, a philosopher mostly known for writing about Zen and Buddhism, and Buckminster Fuller was someone who knew about Korzybski's work. Gregory Bateson, famous anthropologist. So there's a lot of different connections in Robert Anton Wilson. So that's how I got into it. And time binder, get into that. I could tell you more about Korzybski. I guess we'll get into that later. But Korzybski had a term he created called time binder, and that's how he referred to human beings. And the story goes that he was trying to figure out what it was to be a human being. What does it mean? What separates us from other animals? What's really distinct? And he came up with this idea of time binding, that we learn from previous generations so we can preserve their works and we can add to them and we pass them along again. So we can read Plato and Darwin and Einstein and add to that knowledge. And so we have this big repository treasury of recipes and things that we pass on to future generations. And that's that time binding. And so he called human beings time binders.
It's a very unique way of looking at it. I never thought about it this way, but it's really remarkable that we are the only ones as a species that can do it. We can record, we can pass it on. And it used to be just stories around the fire. And I was actually thinking how, podcast as a format resonates with a lot of people because it feels like sitting down and overhearing a conversation by the fire. Back in the day when we were sitting in a cave and stories would be
primal,
passed, right? It connects more with our soul than sitting down with a book, although I love it, but I know that some people prefer to listen. And then the whole idea that we can record it and pass it on and somebody else can read it and we can connect with people that are no longer with us and we can leave something for people we will never meet because they will follow. What is general semantics as a field and how did it come about? And we'll talk more about the details, but big picture, what is it?
Yeah, so it was a discipline Krzyzewski created, and he named it. And it's in some ways an unfortunate name, as people have said afterwards, because that's not such a, people think it has to do with semantics, like just language, and it's not about that. It's not about what words mean or anything about that. It's a more comprehensive way of looking at the assumption that we make in our, say, symbol systems, not just language, but also math and images and everything that we deploy, how we communicate ideas, and what are the underlying assumptions on those ideas, and how do we think about those? How do we think more clearly about those ideas? So the way I like to think of it sometimes, it's a method of critical thinking. It's a way to understand the world. And that's in its most basic sense, I'd say, deals with that.
Yeah, and we'll get into details. And very briefly, can you give us like a bio of Alfred Korzybski? He was born in Poland, lived in the U.S. When was he around?
Born in 1879 and born in Poland, kind of an aristocratic family. Got a very good education, spoke 4 or 5 different languages. Was an engineer by training. Fought World War I. Was injured, and then he moved to the U.S. He was briefly in Canada. Moved to the U.S. Settled in Chicago, and began his great studies. His first book was called, not very politically correct nowadays, Manhood of Humanity. And that book came out in 1921. So, he was already in his 40s. And then the great book that came out was his book on Science and Sanity, where he lays out his whole system of general semantics. That came out in the 30s. Yeah.
Now, you have a way of introducing those concepts in your books in a very easy to follow, digestible way, although it makes you really think. I wonder if we're reading those original books. Are they as easy to read? I'm guessing no.
No, I would say Science and Sanity is a very difficult book. It's a big, fat 800-page book with hundreds and hundreds of pages of footnotes and some math and a lot of other things involved. And so it's a very dense, difficult read book. The students of Science and Sanity like to call it the blue peril. It always had this sort of blue Easter egg kind of blue color to it. And I admit, when I first wanted to learn about Korzybski, I got that book. And then, I didn't get very far at first. I had to kind of backtrack. And I read some more introductory kind of material about it first. And then second time, I made it through. So I've read it a couple times now. And so it's not the easy way in.
Your books are an easy way to get into the topic and get introduced to his ideas.
Yeah, that was partly my motivation, because the first, there was a book about general semantics written for investing, but it came out in 1958. It was written by John McGee, who people know now as the other half of the McGee and Edwards that wrote that classic book on technical analysis of chart reading.
Right.
And he wrote a book. It was called General Semantics on Wall Street. And must not have sold very well at all, because just shortly after they reissued it as Winning on Wall Street. and then it did a little better. But I read that book, and, I was kind of he didn't really talk about general semantics much in that book. He had kind of a very superficial knowledge of it. So I thought, well, I like the idea of it. I kind of use it myself in investing. I see lots of ways where it can be applied. So I wanted to bring it forward. And so that's how I came up to write How Do You Know? I knew it probably wouldn't sell either, but like I wrote in the book, it was a book that I wanted to write. I felt like it was in me. I wanted to get it out. And so That's what made me do it.
I could tell reading it. It's a book you had to write. You had a calling to write it.
I didn't make any money from that book. I published with the Institute of General Semantics, and there's no royalties involved at all.
But you'll make a lot of friends, I think, and a lot of people will reach out to you and follow you.
Met a lot of interesting people that way. That book won the S.I. Hayakawa Award, which is a award the Institute gives out for, distinguished or outstanding works on general semantics. So it was really nice to win that because a lot of, you look at the past winners and it's, I'm in a good crowd. And, looking at the Institute, a lot of my favorite thinkers have been involved in one way or another. I mentioned a bunch of them already before. So it was a nice, honor to have my name in that roll call now.
Yeah. And now you're one of them. I have a quote from your book, and it's the book, How Do You Know? The one about Wall Street. You wrote, "You don't know, not for sure, and you can't know, not nearly as much as you think you can. But to have an idea about the boundaries is the beginning of wisdom." And I thought it's such a powerful quote. Can you tell me more about it?
Yeah, I think general semantics, one of the things that made me really appreciate it. It makes me appreciate how the world's always changing. There's always change. Mm-hmm. No two things are exactly alike, and we can never know everything about anything. So these kind of three things sort of fold in together. And I think it's not particularly original, I think, to say that knowing the boundaries of what you know, your ignorance is the beginning of wisdom. But I think it's a really profound thing to understand, and to really know, to be humble about what you know, what you think you know, to be open to new ideas, ideas that run counter to ideas you held. To me, these are things about thinking, and thinking is, it's not easy really to think. It's hard, sometimes painful, because you have to give up on ideas that you cherished. So, that kind of gets at what I'm, talking about there with that quote.
I like that. And I think in life and in investing, it's very helpful to see that kind of humility, be humble about it, that we can't know everything. And I'll ask you more about it, but let's go back to the time binders. And obviously, you and I briefly talked about it, how everybody is a time binder, all the way from our grandparents telling us stories to ancient philosophers that we can read and find out what they thought at the time. And in your books, you mention some working devices that can help us do a better job, both receiving information, knowledge, and then passing it on. Can you talk about those? They're very useful tools. And the minute you actually see them, you can't look at the ideas in the same way anymore. At least I can't after reading your books.
So you mean Korzybski's ideas like the date and the index and those sorts of things?
Yes.
Yeah. So Korzybski, he was very practical. This comes from his engineering background, I guess. And so it was not just for him. It wasn't enough just to point out these things that we're talking about. He wanted to have a system. He wanted to build some practical set of tools that people could use every day. And so, one of them is he came up with the idea of just using a date. Mm-hmm. So it's like a subscript. So you would say, Warren Buffett, little subscript 1955 is not Warren Buffett subscript 2023. They're different. Warren Buffett now has a lot of different experiences. He thinks somewhat differently. He's not the same person. So it's there to prevent you from making that mistake of just because something has the same name that it's always the same. And it happens with investing too. You look at a certain business 5 years ago and you have this idea of it in your head, and that business 5 years ago is not the same business today. You can come at it with fresh eyes. You can even date your own opinions. You can say, what I think about Berkshire or whatever is the last time you looked at it, So this is a way to keep straight that in your mind that things are always changing. People always change, things change. Mm-hmm. So that's one very powerful tool. It seems very simple, the date, but once you start using it, you'll see it. It also has profound effects, like I say, when you date your own opinions, because then you don't feel so attached to them. Right. You can feel free to change your opinion. You can say, yeah, that's what I thought in 2022. I don't think that today, and no problem changing your mind. It detaches yourself a little bit from those ideas. So that's one of them. And the other one he used was in the index. So this would be, he took it from mathematics. So you might say like Republicans with a little subscript X, meaning that you sometimes say, okay, well, Republicans think X. Well, do all Republicans think that? No, not usually. And they're not always equal. Republican subscript 1 is not the same as Republican subscript 2. They're different. They can be very different. And different investors, we go into the cover, people will use a label like value investors, but value investor 1 is not equal to value investor 2. They're very, very different kinds and styles, even though we have that one word. So that was another one of his powerful devices that he talked about. Dates, indexes, those are two big ones. And the last one I really like also is just using et cetera. So like any kind of description that you put together, you can remind yourself that you don't know everything by just adding an et cetera at the end of it. Again, it seems really simple, but when you start using these things and using them in combination, it definitely changes the way you think. It really will. You'd be surprised.
I like the last one because it makes you realize that there might be more items, data points that you have not considered. And you don't have to know at the moment what they are, but just to be aware that maybe you missed something. And I think it's a nice exercise to have. And
that's it. And what you missed might be important, might not be important, but at least you have the idea that you don't have it all.
You don't have it all. I was very intrigued by the cause and effect discussion, or that's how I interpreted it in your books. So in the world of investing or in life in general, we like to boil everything down to a very simple cause and effect. The rates go up, the markets will go down. And when I'm richer, I'll be happier. And not only you share how nothing in existence has a particular cause, but also the terms that I just used are abstractions. Can you tell me more about both?
Yeah. Well, this is one of the things I loved too when I was sort of studying general semantics. And I remember, Alan Watts had a nice little story or analogy he gives where he says, the way we think about cause and effect, it's like we're looking through the hole in a fence and we see a cat's head walk by and then we see the tail, and then we come by and we see the head go by again and then we see the tail and we think, well, the head causes the tail, and that's what really cause and effect thinking is, rather than see it all as one movement. So I like that analogy, but yeah, a lot of, cause and effect, it's hard to say what, causes something else to happen. Right. And when you really think about it, it's usually not one thing, it's multiple things. And even then, it just sort of begs the question. There's this long chain and just goes on and on, right? And so I think that's good to keep in mind because a lot of times in markets we have, like you mentioned, these simple relationships and then they wind up breaking down at some point. It's very costly. Like the idea housing prices always go up was a key little thought in the great housing bubble in 2007 and 8. And you see them happen again and again, those kinds of ideas.
And I think it can cut both ways. On one hand, you might expect to make money in something because you think, I think you give an example of gold and gold miners. And gold actually went up, but one of the major gold miners did not go up over that period, right? So you were right.
So you could have been dead on about gold and still have made no money on that stock. And there's lots of instances of that. I remember the example I used in the book too was something about Brazil, and there's all these bad things that happen, these mad macro events, and you could have gotten all those right, and yet the ETF went crazy. It was up however much over a period of time. And same thing with predicting the earnings on, the S&P. There are stretches of time where the earnings have gone down, or gone up, and you would have even made that prediction, and the prices went the other way. So cause and effect is very tenuous.
It's fascinating, especially if you're managing money for other people and they hear the news and they see you buy or sell something and then they ask you, why would you do it? And just as an example, the recent story with some tech companies that are laying off a lot of people, and clients would ask, why would you be buying a company that's laying off a lot of people? And the peculiar thing, or not so peculiar, is that those stocks actually end up going up on the days when they announce the layoffs because people see it as a cost saving. So you can retrospectively interpret the fact and say, oh, the market appreciated the fact that the costs will go down much more than a signaling that the business is not doing so well because they're laying people off. You never know which one will be the leading factor, but it's...
Well, that's right. And, same thing where when people are very worried about a recession and it's all in the headlines and everyone's talking about it, and then you buy a stock that's sensitive to recession, say you're buying a trucking stock. People are like, well, what are you doing? Why would you do that? Well, that expectation is out there. It's built into the price. Most of the time, that's the way it is. So
yeah, everybody knows, or we think they know. You introduce another term that's not an easy one to to pronounce. It's the structural differential. And now I know why he liked those terms, because he had a background in engineering. And you tell a story of a dolphin, a Ferrari, a democracy. You're talking about somebody watching a dolphin, then you share a story what a Ferrari is, and then you talk about democracy. And then you emphasize how we give greater importance to higher abstractions, democracy being the higher abstraction. Can you talk more about it? This part of the book actually made me more at ease about watching daily news that focuses so much on the higher abstraction. But you remember the story about the dolphin, the Ferrari, and the democracy?
Yeah, I mean, the structural differential is a model that Krzyzewski created, and he actually used to fashion these things physically, and sometimes he'd make them out of nice wood and things that it's hard to describe them on podcasts, but you'll have to look up structural differential. It's a bizarre looking thing, and it hangs. There's this thing at the top, and that's like the event, the world out there, and all of its endless details and sights and sounds and smells and things we can pick up and can't pick up. And then there's that first level abstraction, which is what we take from it. So if you see like a car wreck, there's all these things that go on, but then you see one point of view and you pull out certain things. So that information then is like one remove. We're not even talking about language yet. We're just talking about what you're taking in.
Right.
And then converting into language is like, you're in the structural differential, you're 2 steps removed from the event. So now you're starting to put together, it was a blue car, I hit this car. And then you make even further, inferences as you go down. You get further and further away from the event. So what Krzyzewski teaches is that in general, you want to give more weight or importance to things that are closer to the event than distant. So as we get further and further away from things, we get to very, very big abstract terms like you mentioned, democracy, capitalism, big abstract terms that are very far away from what they describe. The economy. What is the economy? We can think about where that came from. First, you have some buyer and seller, you have transactions that go on and just keep stepping back. And then we have this thing called the economy. And what general semantics partially guards you against, warns you against, makes you careful about is how you manipulate those very big abstractions, how you talk about them, and what you think about them. And so to your specific point, like, I don't remember specifically what I said about the dolphin and the Ferrari, but I remember those are orders of abstraction, right? So
yes,
something that you can point to and you see a dolphin cresting out of the water and you point to it. That's something very close.
Yes.
That's the event, right? There's no interpretation of all. There's no abstractions. There's no words. I point to it. You will look at it. That's it. And then, versus stepping away a little further. If I were to say to you a Ferrari, you have you imagine a Ferrari. We're not talking about a specific car that we can point to. We're talking more of a concept, but still relatively specific concept of Ferrari.
Right.
And, you get further and further away. So the idea there is to make you aware of those general levels of abstraction. And
I walked away thinking that we should all be spending more time watching dolphins that were getting too worried about the election outcome. That was my
might not be such a bad idea. Yeah.
You make a point, I think, around the same part in the book, how people are so worried about the elections, but the day after, they still wake up, they have the same food, they sleep in the same bed. And that really made me think, because it's very true, but we feel like the next day our lives will be completely different.
I think about that a lot. I think about that like in terms of investing, you go through periods where the market's tough or whatever, but if you really think about it, what changes exactly, really, right? You still get up, you're in the same bed, still the same family, you still look the same, basically. And keep those things in perspective.
I like that. So let's talk about zesty ginger turmeric sweet potatoes. You mentioned them in your book, and I had to highlight that. And you talk about the power of labels. And I have a quote from your book. You say, investing blindly or by labels only is the way investing is going today. More and more money flowing into more and more ETFs. It's industrial investing, like industrial farming. It doesn't have to taste like a real tomato. It just has to look like one so they can sell it to you. I mean, Chris, wow.
Thank you.
That's a good one.
Yeah. I mean, I think that's true. I mean, the zesty turmeric, what were they again? Carrots.
It was carrots or potatoes?
Yeah,
it was, I think
carrots or potatoes. One of the other, doesn't really matter. But the idea came from an experiment. There was involved a lot of people in a cafeteria, studied over a period of time where they experiment how they label the foods. And they, just put out simple and you call them carrots. And then they would play around with the label and, be like, is it lemon citrusy carrots? And then they'd have, cholesterol-free carrots or whatever. It didn't have to, necessarily make sense. And then they had them very descriptive one. And you could see that the way they label them would definitely have significant statistical significance in how people would choose it. And so the really, the enriched restaurant style description, it was like a 40% increase. People would go for the carrot over just calling them carrots. Huh? And in fact, when you labeled them in a health conscious way, it actually hurt. And it could have suppressed it, so people almost didn't want it. Even though it was the same thing in all cases. They didn't change the actual carrots at all, just the label. So I was fascinated by that. And I think, a lot of life is like that. And you mentioned investing. I mean, it's the same thing. People, I feel sometimes like it's very difficult to just be a regular retail investor because I don't know how they would necessarily know. They're more easily fooled. If someone tells them this ETF is a home building sector, bet on home building, they don't think to really look in it, really, well, what is it really in there? A lot of the investing on that level is just with labels. So that's why all these big investment houses create endless funds that with labels that are, whatever the hottest thing is. Just
it looks like a tomato. It doesn't have to taste like one. I really spoke to me. And you mentioned, .com. Nowadays we have AI. Until yesterday we had crypto and companies that were not failing and had no business. If they now say that they are using AI and go into a different business line, suddenly the stocks are up just because there will be an AI, and I'm excited for them, but I think there will be fewer winners than people think. I remember a client share with me that he decided to put some money in a happiness fund, and I asked, what's a happiness fund? And he says, well, they invest in companies that make people happy. And I said, I hope most of the companies we invest in make people happy.
It makes me think of ESG too. That's another powerful label now, right? And we already have systems where we're trying to reduce companies, to an ESG rating to a single number, directing people to invest just, based on that. I use Interactive Brokers and they have ESG ratings and I can't make heads or tails of it. They don't make any sense to me. But again, you're going to have a lot of people, maybe not a lot of people, but maybe we'll see. Dollars invested that way based on this very abstract label and ESG rating.
I don't know if it was a joke or if it was true, but I saw a headline that one of the major cigarette manufacturers aspires to get a very high ESG rating in the next 3, 4, 5 years, something like that. And I just smiled. I didn't even open, but I thought if that's the direction, that's interesting. In your book, you say you like to ask the question, is that a fact? And you write how what most of other facts are just, how do you pronounce the word? Is it inferences? Inferences? Inferences. What's the difference between the two and how that can help us navigate the world? I thought it was really eye-opening. It made me pause because some things that I used to think are facts, I know now they're not at all.
Yeah. Right. So general semantics, most of the practitioners will try to get you to raise the bar, raise the threshold for what you consider a fact. And I always think of the famous talk by Irving Lee he gave once. And I write about this in the book where he holds up an apple and he says, are there seeds in this apple? Is that a fact? Is that something or is it, and he makes a point, you don't really know until you cut open the apple and see. You assume it's a fact because all the other apples you've seen have had seeds in them, but you can't say this one specifically.
Right.
So he goes through these little exercises like that, and he does it in a very better way than I just did it. It's more of a little bit of more shocking and makes you think more. But
I think you mentioned that he says, "Would you die for it? Like, would you bet your right? Would you bet your life on it?"
That's right. That's right. Mm-hmm. He raises the bar. He says, "Well, would you be willing to bet your life on it?" And then people obviously, well, wait a minute, would I?
I'm not that sure.
Not that sure. So he kind of breaks it down and thinks, well, a fact is something that you can observe and you can physically verify, and inferences are other things. There are some other levels in there that he includes, but even just adopting that one, I mean, it's a pretty high bar suddenly for what's a fact.
Mm-hmm.
And then just keeps you a little more on your toes about what you think you know or not.
It goes back to the dolphin. If you and I actually on a boat looking at the dolphin, we saw a dolphin, but if we tell the story and the story gets retold, the dolphin may change color, look, shape, and everything else. And actually, if the source is not reliable, it might not have been a dolphin at all. right?
Yes, absolutely. And there's lots of examples of thought experiments of that, right? Where people have told a story and retold it over many, many times, and it changes dramatically by the end.
It's a completely different story.
Eye-opening when that happens.
So speaking of facts and inferences, you quote Martin Sosnoff. And I heard his name. I've never read his books, and I will read his books after reading yours. And the quote is, "A running theme is a futility of relying too heavily on facts and figures. His first law is the price of a stock varies inversely with the thickness of the research file." And you add, "Really good ideas are often strong enough to overpower the finer details." I love that.
Yeah, I'm really a big fan of Sosnoff books. They had a big influence on me early on when I read them. There are two in particular that I like. I know neither of them are in print, but one is called Humble on Wall Street, and the other is called Silent Investor, Silent Loser. Both excellent. I mean, I think he's not the same kind of investor I am. He's different that way. He's more concerned about macro and other things. There are a couple big lessons I took out of Sosnoff. One was he really drove home the idea of power of having an insider ownership. And then one of my favorite lines of his is, "Entrepreneurial instinct equates with equity ownership," which I always loved. And then this one, which is the point you're making, which is he's very much pushes back against the tyranny of numbers and thinking that you know something because you can put a number to it, or that you can put a lot of research behind it. So he often talks about how his best ideas were something where he had the least bit amount of evidence that he could really point to, but they were really stark.
It's the argument that in investing, the best ideas, when you look back, they were really obvious.
Almost obvious, yeah.
Right?
Really
They're staring.
Scream out at you. And the ones that you got to sweat over and you're torturing yourself with models and getting all this extra detail to try to justify it, right? Those are the ones that do the worst. That's the idea of the returns go very inversely with the thickness of the research. More work you got to do, Sometimes I do think about that. I'm like, well, this could be a compelling idea, but it's a lot of work and it's probably not worth it.
It's almost like trying too hard, but the investment profession praises the detail. I had the experience of working with people that loved DCFs and very detailed DCFs with years and years and layers by product and all those things, products that haven't been even announced and launched with unknown pricing or
right.
addressable
We've all
market.
seen those big, 100-page decks with lots of detail and just like, you're just wowed by it, right? And you're just, wow.
So,
versus some very short, could be 1 or 2 pages, right? So I definitely agree with you there.
So that's one side, the obsession with that kind of detail that we think we can know, which going back to what you said, we might not know. And the second thing, there is this term of not leaving a stone unturned. And I've heard it so many times. We would present an idea and somebody would ask, are all the stones, turned? Have we checked everything? Do we know everything? Have we asked everybody? And I never knew how to answer that question because you call those in your book impossible, meaningless questions because I can't possibly answer that. Have we asked this or have we asked that? We haven't.
Pathology-inducing questions. That's another one too. That's ones that just cannot be answered.
No. So you just smile and move on because you can't answer that question. And in investing, I think it's a trap that. And now there are so many more ways to get the information. Obviously, the companies give you all the filings. They report more often than they give you guidance. They give you so much information, and then you can look up experts in the field. You can go visit the facility. I mean, in my line of work in investing professionally, I even was invited to sit on a new FedEx airplane to do due diligence of FedEx at their investor day. They put us in a bus and they showed us a new plane, and we walked around a new empty FedEx cargo plane. And I thought, I'm enjoying this. I love planes. I fly small planes. So I had fun. They let me even sit in the pilot seat. The plane was at the airport, wasn't flying. And I thought, but from a research perspective, what value does it add apart from an anecdote I'll share over and over again, right?
Right. And in fact, more information doesn't necessarily lead to a better decision, can actually lead to a worse outcome. And there's a variety of experiments on that too, where you take experts choosing whatever it is and you give them 4 factors, then you give them 16, you can actually see a marked decline.
Exactly.
So it's one of the things I think about a lot when I'm investing in the companies. I try to really kind of get it, the essence of it, for lack of a better word. It sounds mystical, but I don't mean it that way. Just like what's the what are the really key important pieces of this business? And usually there's just a few things that are absolutely critical. And, if they break down, then you have a problem. And then a lot of the other stuff is just sort of details that kind of come out over the wash over a very, very long period of time. So I think about that a lot.
I think investing is a hard profession for people that have to know everything in any field they choose. If they have to know everything, I think it's a very hard place for them to be. And I've met quite a few people in investing that really feel that if they spend enough time and if the research file is thick enough, they'll really know everything. And I think they should read your books.
It's a hard business if you want to know everything. It's also a hard business if you have the urge to be right.
Oh, that's
a deadly one. I mean, I've seen a lot of that, and people just feel the need to be proven right.
I say that I want to be the least wrong. And some people get it. Some people are not impressed with that statement. But that's, if I'm the least wrong, then
I like that.
I'll be around long enough to make the snowball big enough. That's how I look at it. And that's what I try to focus on. There were at least two things that shocked me, but in a good way in your book. And I think that was the purpose of it. One is you say how 1 + 1 doesn't always equal 2. And the second one, you say that history can be rewritten. And I love history. But I love history in terms of, people and stories and experiences. I never really liked the dates and the generals and the battles. I thought there was more that happened that we should spend more time understanding. But you say those two things, 1 + 1. So you undermine my, primary school mathematics. And then my history teacher would be crying over here. But tell me more about both, because you have some really interesting observations that you share.
Korzybski was into this, where he would say, he'd say 1 + 1 is 2. That's like it's some identity we all accept. People say it almost as an argument. 1 + 1 always equals 2. It doesn't always equal 2. 1 + 1 equals 2 it's a symbol system. It's an abstraction. It's set up in a certain way. But in the real world, when you add one thing to another, you don't always get 2. And he has a variety of examples from science and chemistry. One of them I remember is if you add 1 gallon of water and 1 gallon of, I think it's alcohol, you have something less than 2 gallons of liquid because it becomes somewhat denser. And there's other things he adds there. When you add light to light, you don't get twice as much light. The laws of reflections, actually, you can create blindness with that way. So there's lots of these things in the real world. He adds different, there's different atoms you can add. The same thing don't work quite the same way. So the real world is not additive. It doesn't have that principle. And in business, we know that too. You put one company together with another company. Sometimes it's not that you just have two that were the same before. You can very much have something less or more, depending on how that goes. So, I started the book. Well, that comes pretty early in the book because it's trying to get you shake you out of your certainties
comfort zone
of your symbol systems, as they would say. Yeah. And then history is somewhat similar. You just said it. You said, when you said history, what is history to you? You said it was stories and experiences, and right. So that's what I think it is as well. And those stories can always be retold. Yeah. They always be told in a different way. There is no such thing as history as just one thing that is permanent and stays the same all the time. It's just, again, going back to those models that we talked about. You have to pull out certain things. Well, what do you pull out? And it's up to the historian. They're the one who picks and chooses, and that's why every generation we always have a new biography of Abraham Lincoln will come out, and you're thinking, well, what the heck could possibly anybody say about Abraham Lincoln that hasn't already been said in countless biographies? But there's always a new generation that wants to interpret the story or reinterpret the story in their own way. The same thing with any big historical event. The American Revolution, you could tell the American Revolution through a dozen different lenses, right? So in that sense, history can always be rewritten for the same reason. Any story can always be retold in a different way.
And we haven't discovered it recently. I think it existed as long as we've been recording history. I remember a story of a battle in ancient Egypt. I think it was one of the major pharaohs, and the battle ended in a peace treaty, but nobody really won it. It was so bad for both sides. And historians, archaeologists find depictions of that battle from different points in life of that pharaoh. And the older he was, the battle sounded more and more as the biggest victory of him as a young pharaoh. So they were rewriting the history in the past as he was living to make him even more glamorous. And basically in the end, it was the story. Of course, he was such an amazing pharaoh that I think he lived a long life. I think it was Ramses II, and it was the Battle of Kadesh. And, but the story was rewritten as he was living. And I think he had quite a lot to do with it. But it's fascinating that we do it these days too. And it's not just that we turn battles into victories, but the interpretation of what that point in time actually meant to us also evolves. So that I found fascinating. I'm familiar with the concept of delayed gratification, but you share the idea of delayed reaction in your book. And I think that's something that I practice, but after reading your book, I think I'll practice it even more, not just in investing. But can you talk more about it? What is delayed reaction in life and investing?
Yeah, it's a difficult thing to practice, but if you keep at it, I think you can get better at it. So the idea Korzybski taught was that he was trying to go against this, where certain words would come out, certain phrases or images, and you have an automatic reaction to it, you know. So he was trying to he wanted to teach you to sort of pause a bit, not come up with not react or judge it right away. The idea to leave yourself kind of open time to reflect a little on what.
Somebody came up to you after your talk who was wearing overalls.
Yeah, this is a story I've told several different times because it had a big impact on me. So apologies for those who have heard it yet again. But I remember it very, very well. I was young, investment researcher, analyst, writing my newsletter at the time, and I was at a financial conference, and a guy came up to me after one of my talks, and he was wearing overalls, not joking, like full farmer overalls. And my immediate reaction to when he came up was, this guy is just a country bumpkin, and I don't know how he got in here, but I can't wait to get out of this conversation, kind of thing. But as soon as, I started talking to him, I was completely wrong. I mean, this guy was, a very smart, successful, investor, person. And that, in part, that's why he could do that, right? That's why he could walk into a room like that and not have any worries because he was so confident, sure, comfortable with himself. So after that, I vowed I'd never do that again. I would never judge anyone like that again. So that's the story there, and that's the experience.
I think it can help us all in life and in investing just to save the judgment until a moment later, because you might be just wrong in any direction. And I think it's our natural inclination is to judge quickly. I mean, I'm sure you've seen it too, where there's these different studies that come out and say people make up their mind whether or not to continue to read a piece within 7 seconds. So I always think of that when I used to write my newsletter at Agora. We would always focus a lot on headlines and leads because we had this in our mind. You only got seconds. That reader's going to make up their mind whether they should continue to read or not. So you gotta grab them right away what you want and to bring them in. And it's the way we're wired to be. And I think Korzybski's teaching was to push back against that and delay that judgment. And how far can you really get with it is kind of a little challenge, but. And I think you share that people don't buy something because it's an oil stock, but it's not really. People don't buy something because it's a tech stock, but it's not really. And I think we make those quick judgments, and we both omission and commission kind of errors where we decide not to participate in something, or we think it is a home builder ETF, but it's not, right? So you actually give yourself a little bit of time to see, what are you looking at? Is that really a tomato? And
yeah, that's right.
It really resonated with me.
Is the label right?
Is the label right? You use the term English minus absolutes. And I really like this idea because I feel like from the early days of school, like any school, we're taught in absolutes. There's one correct answer. And it goes all the way from the 2+2 all the way to building an elaborate DCF in grad school. And I remember one specific professor, and maybe he's even listening to this, but he thought that there will be just one correct answer or a very small range around a certain amount, price. So we did the study, we did the DCF, we built it, we all came up with different numbers, and he says wrong, wrong, wrong. And then one person was almost right. And we said, what does it mean to be right with a DCF? And he said, well, the company sold for this much in real world. But we both know that what things sell for doesn't really mean that it was the actual value. And it could have been worthless the year after. So.
Right. And your inputs could have just accidentally got to that number, right? There's lots of ways to get there.
It's like I thought he's
eigenvalue problem. To present value of today's company, you can get there at dozens of ways.
Exactly. So I thought he's teaching an interesting tool that can be used in interesting ways, but I think he got it wrong what it's meant to do. And I had other teachers that introduced me to DCF all over again, but I thought that one specific one, again, made me think in terms of absolutes. So let's talk about it. English without absolutes and why absolutes can get us in trouble.
Yeah, I like English minus absolutes too, because it's one of the things that's really easy to apply and start using.
Yeah.
There's a long list of words that are absolute. So, always, never. Those are like simple ones, right? Anytime you hear anyone say always or anytime you say never, those are should be little flags that go up and make you at least question, always? I mean, really? Or never? And,
nobody goes there anymore. People say
nobody goes there anymore. Yeah, nobody, or everybody. I have a list of a variety of absolute terms, but once you start getting attuned to those, and your little inner general semanticist will start flagging those things and make you pause a little over those.
Think about it a little bit more. Yeah, no value investor would ever buy it.
That's all it's supposed to do. Just makes you pause and think, and maybe that it's harmless and you just move on, but it might be something that's really worth pulling out and saying, well, wait a minute, that's not right.
Yeah. But in investing in those moments, and we call ourselves contrarians at Seacard, but the idea is that there are times when it pays to disagree with the crowd. And when the crowd says never or ever or forever or always, and you pause and you realize maybe it's a bit different this time, or maybe the situation is unique, it can actually create an opportunity that you might be noticing before anybody else appreciates it. So I think that moment can really make a difference. And
it's actually one of the, reminds me, you said, it's different this time. It reminds me, that's what everybody likes to say. That's the right, most dangerous words, but it's not really, I always think that's a very ironic that would be the case, because it's always different. Every time is always different from every other time. Never the same. Different people. Well, I said never right then, but the people are different. Different times, different. Now the broad outlines, I know the intent of it is the broad outlines of bubbles and busts are similar, but
I think
those details could be important.
I think this term is used different this time to cover up a bubbly situation in the markets, that somehow, for some reason, we should accept that prices.
It reminds me, one of the really good formulations in general semantics is it teaches you to see differences where others see similarities, and similarities where others see differences.
There you go. I like that. It's they zig, you zag, and the other way.
Yeah.
So that we manage money for families, family fortunes, multi-generational wealth. And there was a quote that I really liked. So it's a quote from Schopenhauer. Wealth is like seawater. And Schopenhauer wrote, the more we drink of it, the thirstier we become. And you share the idea how we will never find contentment. And we need to moderate our desires. And I thought of Buddhism, and I thought of Charlie Munger, and I kept reading your book, and you mentioned both of them right after I thought of them. But tell me more about it, because investing is such an interesting pursuit. We are exposed to a lot of wealth, and we see wealth grow. And then we grow our own wealth, and then we see people that made fortunes in their lifetime and want to keep it and grow it. But then Schopenhauer says it's like seawater, and Munger reminds us of expectations and keeping our expectations in check. And I think it can really interfere with the investment process, wherein you need more, want more, and chase things that are riskier. So it's a bigger idea behind it. But what are your thoughts?
Yeah, and it seems to be a very, it's an idea that recurs in all the different wisdom traditions, right? There's always this idea that you have to curb your appetites, your desires, because that's the root of the whole thing. You never something in us is just never content. It's always more and more and more. What's the next thing? What's the next thing? I just remember, I remember coming into college, and my first job when I got salary, I think it was $28,000. I thought, wow,
you made it.
I'm set. It just seemed like a tremendous amount of money at the time, right? And then there's been little milestones along the way where I'm like, geez, that's it, but then this fades, and then you find yourself, reaching wanting more. It's really weird. Some kind of, hard wiring. So, I think that's what all these different traditions aim to do, is help you. The only real way to find any sort of contentment is to peel back those desires and be content with what you have and appreciate what you have. And
And I think with that mindset, you're more at ease even investing because you don't feel rushed. I've talked to a lot of people, like the people I work with, but other firms that do what we do, that manage money for families, and anybody in the investment profession that is very close to the clients and knows their needs. It's the evolving expectations. And then there's this moment when neighbors are getting richer faster than you. And I think JP Morgan said it, that no money was, well, again, in absolutes, but no more money was lost than through the envy that the neighbor is getting richer faster than you. And it doesn't matter if you have 10,000 or 10 million or 100 million. I think it can get people in trouble. And I noticed that in a pronounced way in 21, 22, when we had the big bull market out of the blue that surprised many of us. I don't know if all of us, but a lot of people that I know that were very disciplined and have had experience with other bull and bear markets really gave in to some silly ideas and took on risks that in my mind were not acceptable. So there is a thought there that keeping your expectations in check can really help you, not just to have a better life and happier life, but don't risk what you can't lose. I think that's right. That's what I heard reading your chapter.
That's good. Yeah. It reminds me too, just the general power of compounding. Even, you take a 10 or 12% number and you put it out over 20 years,
you'll do just fine.
You'll do just fine. Yeah.
So speaking of doing just fine, the concept of success and failure. And I like the way you introduce it in the book, that the outcome can be more nuanced. It's not an either or situation, which is another term that you use. And I wrote an article about success and failure as a concept. And I thought it was really interesting because people think of, and in the article I say success, let's say becoming the richest person in the world, and failure becoming a homeless person, right? And I said, not becoming one and not becoming the other one doesn't mean the other, right? If you don't become the richest person, doesn't immediately mean you're a homeless person. There's a whole range of outcomes in between that will probably be good enough to have a decent life. But we don't think that way. We're sold on winners and losers, the stocks of the day, the managers of the year, the managers of the quarter. I mean, we're sold on this idea, but you introduce the concept of a more nuanced outcome. Can you talk about it?
Yes. One of the things Korzybski was big on is he had this idea of either or. And again, it's one of these ideas that anytime you see that sort of construct, it's supposed to, again, raise a little flag in your mind to ask, well, is there really only two options? And there's usually not that. That's not the case. There's gradations in between. So you can't take all this stuff to extremes, because I always think about, well, if somebody says you want pizza tonight, it's yes or no. You don't have to get to, well, let me think about this. There's actually gradations in your question here. But for a lot of things, for most things, the important things, there isn't just one outcome or the other. There's all kinds of things in between, and success and failure is a great one. Because people make plans and have goals, and then they either meet them or they don't meet them. And it's not really, that's like a road to unhappiness and unrest and disappointment. I think you set those kinds of things up that way.
Well, I think of Berkshire, Buffett, and Munger. So Buffett at points in time was the richest person in the world. And Munger, that's sitting right next to him at the meetings, he has 1/40th or 1/50th of Buffett's wealth. And he seems to be just fine. But I think Tom Gaynor from Markel, he had a discussion with William Green in William Green's Richer, Wiser, Happier podcast about Olympics. How in Olympics, if you're a fraction of a second slower than the first person, then people don't even know your name, and forget if you're the 5th or the 50th, but you're still...
Wisdom of Ricky Bobby. You're not first, you're last.
Right? But in life and in investing and with money, it doesn't work that way, right? No. If your neighbor has 100 million and you have 25, you're still just fine. You'll probably be as comfortable and not take as many private jet flights, but other than that, you'll be fine.
Sure.
And I think keeping that.
And there's the journey there. I mean, there's the whole, as you're an investor, you're okay. So let's say, I don't know, everybody wants to beat some benchmark or something, but let's just say you didn't. I mean,
what then?
Not the end of the world, right? I mean, you still could do very well.
So you're touching on something really interesting. And I think there's so much attention put on outperformance in investing. And almost people think, why bother if you're not going to outperform? And you quote the story of Bill Miller, who is a legendary investor. And he himself explained his record, which was, I think, 15 years until 2005. And I remember reading this story either in his book or a book about him, how if you took, instead of the end of December to the end of December, any other month of the year, so any other 12-month period would have not shown such a regular outperformance. And it made me think something that I kind of intuitively knew, that outperformance is such a peculiar concept to look at.
It is. Yeah, he wrote about that in one of his letters, Bill Miller did.
Okay.
And I remember they looked at it internally and they shifted and looked at every other 12-month period during that time. And that December year end was the only one that they beat the market the whole time. So you're just like, how random is that? You know?
But that's the one that got all the attention. That's the one that...
That's the one, yeah.
That allowed them to raise so much money. And needless to say, he had a really tough time after that and lost quite a bit. But it's really peculiar how much money gets shifted, not just because of labels that we talked about, but also because of a very arbitrary way of looking at the outcome, the performance. Not only the index is, as you say in your books, S&P 500 of today is not the same at all as S&P 500 of the year 2000. Yeah. So you're not even comparing apples to apples. And it's an event, right? It's more of an event than a fact. And then...
Yeah, the changes in the S&P 500 are kind of astounding over time.
Exactly.
I mean, they didn't have financials in it until 70, so
the S&P 500 continues to change and evolve. And I think, if anything, the rate of change is going up because companies come and go and they will be added and removed from the S&P 500 at a higher speed than ever before. I think it's a big theme. So it's an interesting concept. I have nothing against investing in index funds, but there has to be a context where it makes sense. Mm-hmm. The big idea these days is that we are living in these uncertain times. And again, I think some people say it's never been more uncertain what's next. And you have a quote from Korzybski that most of our problems seem to stem not from uncertainty, but from mistaken certainty wrongly applied. And I really thought about it. Can you talk more about it? It's a different perspective of looking at the world around us.
Yeah, read it again.
So he said that the trouble comes not from uncertainty, but from mistaken certainty wrongly applied.
Yeah. Yeah, I like that. Mistaken certainty wrongly applied. Yeah, I mean, it makes me think of all the things that we feel we're very sure about, and then
it's not so.
It's not so, and those are the things that cause us the most grief.
Yeah.
So if nothing else, it's another reason to be, humble about what you think you know, and be open to very different possibilities than what you think today.
Mm-hmm.
But it's a great quote. I mean, he has a lot of interesting things to say, just about uncertainty generally. I mean, in some ways, general semantics its central theme is uncertainty, if you think about it.
We don't know. And what we know might not be everything. And we might know the wrong thing at the wrong time, too. So it's a very humbling approach. When you invert it, like Munger likes to invert things. He says, tell me where I'm going to die and I won't go there.
Yeah.
Then I always think of what can get me in trouble. And
don't go there. Yeah.
And I choose not to go there. And somehow, I don't want to say you know those for sure, but in the world of investing, you can list things that can very likely get you in trouble. They can have a disproportionately favorable outcome if some things line up.
Yes.
But it doesn't make them less
right.
risky or less. The range of outcomes can be really, dramatic. I like the concept of no zeros, and it's just a simplified approach that I like to have, where I look at an investment, and if I can imagine going it to zero, like for example, anybody that was buying one of those failing banks 5 minutes before they went bank, they were gone with their bank runs recently. I thought, you must know that one of the outcomes is zero, right? You must know going in. So these are the situations where I choose not to participate. But I think people thought that maybe a miracle happens and they will not go bust. And then something goes from 20 cents to $20. And it has happened in the past with, car rental companies during the great financial crisis. I remember that happened. They went from 50 cents to many dollars. But in cases like this, I just choose not to participate.
It makes me think too, if you're willing to accept a decent chance of a zero, then the longer you play, the more certain it is that you'll hit that zero. Mm-hmm. So that's the other thing investors sometimes do. They get too much focused on a particular case and not the overall odds of playing that game again and again and again.
I know investors that divide their portfolio, and on purpose they have a third or a quarter of the portfolio in what I would define as potential zeros. And they call them high risk, high reward names. And then the other 2/3 in names that don't have that outcome. But I feel like mentally it's such a hard thing to do, to keep the wall between the two, because at some point you will compromise. And I think I would eventually fill up the whole portfolio with potential zeros. And it's
that's exactly what happened. I did that when I was younger. I would remember I have a higher risk section of the portfolio.
How much of the portfolio eventually?
and what you wind up doing is what you say. I mean, you eventually wind up compromising, and you own a portfolio full of
right.
And
it's a choice. I know investors who do just fine. At least so far, they've been doing just fine with portfolios like that, and somehow they have the stomach and they can still sleep well with portfolios like that. So that's the beauty of investing, and even people that consider themselves value investors. It's a wide range, and no two investors are alike, and something that somebody can hold and sleep well might be something I can't sleep well with at all.
Yeah. Sometimes I think of it as like an ecology. Like there are birds that like to be in the trees and frogs that like to be in the ponds. So there are investors that have different areas they like to be in, and they're uncomfortable in, each other's zones. It's perfectly fine.
As long as you're honest with yourself, and if you're managing other people's money, then you have to make sure that you're on the same page with your clients. And that's, I think, one of the hardest things in investing, to be on the same page with your clients. And your clients will evolve. They're not static. As your books talk about, nothing is really static. So what they tolerated when they were 35, now at 65, they might have a different view on you holding certain things for them. So it's an ongoing conversation. You have some questions from Wendell Johnson, who is one of the writers that you quote. And I really like those questions. And I thought anybody listening that wants to have a quick tool to look at things differently. The questions are, what do you mean? How do you know? What then? What do you mean? How do you know? What then? Is that a good place to start for anybody that wants to question things around them and look at things differently?
Yeah, that's a good series of questions. I mean, Wendell Johnson was one of the famous, lack of a better word, popularizers of general semantics after Korzybski. And he wrote a book called People in Quandaries that's still in print. It's a good book. There's a back half of it I wouldn't pay attention to, because he was also he was a speech pathologist and into helping people, their stutters. And so the back half of the book is not really relevant to the last section. But that series of questions comes from another book of speeches called Semantics for Change, out of print. But I really like that book. I like that series of questions as well. And
it makes you pause and think, right? When somebody tells you something.
That's all it's about. It's really just making you pause and think over the words you use and the ideas that you hold.
It's interesting because it all depends on the perspective. We have summer interns now and then, and they're very curious to learn, and they find a headline and they come up to me and they read it and they say, look, this is bad news. And I say, well, let's think about it. If you want to buy the stock and the price just came down, is it really a bad news? And then I ask them, is it a permanent damage to the business, or is it just missed earnings? And then it gives them a different dimension to the news they just thought of either or, bad or good. Well, bad in what sense and good in what sense? If you're a buyer of stocks, you want them to come down and you hope that there's no permanent damage to the business. And it's interesting how you can build more layers to your interpretation of the world, not just good or bad, but is it good for me right now? If it's on sale, maybe it is, if I want to buy it. Mm-hmm. Chris, I like to close out those discussions with the idea of success. And you and I, in the last recording, talked about your definition of success. But in your book, I found a longer quote that I really liked, and I'll share it and you can add to it. And the quote is, now, before I end this book, I must ask at last one big question. What does it matter if you succeed or not as an investor? I ask you to give it some thought. Many foster an illusion of thinking things will be better if they have more money. Things will be different, that much we know. It's one of our basic propositions. But human beings seem hardwired not to be content. Whatever you achieve, you will always want more. And I thought this is really powerful because we want to be better at things. We want to have more money. We want to be better investors. But you asked a deeper question, which we just borrowed from Wendell Johnson. What then?
Yeah. What does it mean? I think the way I think about it too is, do you enjoy your everyday existence when you get up in the morning and do you have a good day? And you just keep piling up those good days, and then
it's been a good life.
Yeah. It's been a good life. Will it matter that much? Like we were talking about before, whether you have, X or a little less or a lot. I mean, this makes you think about it.
Yeah. Chris, I had so much fun with you again. And those 2 books are really wonderful. They made me think. And I told you there are very few books and I read a lot, that make me really pause and think. So I appreciate you writing them. And I told you that I have an image, a visual of a gun flare, a flare going up into the sky. And you never know who's going to see it. And to me, a book or a podcast or a blog post, it's that kind of a flare. You send it out to the world, and you already told me you met a lot of wonderful people through those books. So I hope that continues to happen. And you made a lasting impression and influence on me through those books. So I want to thank you.
Well, thank you, Bogmel. That's very nice of you to say. Appreciate it. Great to hear.
It's always a pleasure.
And it's great to be on with you. It's good, fun conversation.
As always, and I hope we can do it all over again. Are you working on something that you can share right now, or?
I am not. I have no book ideas right now at all. So, but, never know. I'm sure something will come up.
Yeah, when you create the space, something will pop in, and we'll have another excuse to catch up. Chris, thank you so much. What a pleasure.
Thank you.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski. The content of this podcast is for general informational purposes only, and so are the opinions of members of Seacard Associates, a registered investment advisor, and guests of the show. This podcast does not constitute a recommendation to buy or sell any specific security or financial instruments, or provide investment advice or service. Past performance is not indicative of future results. More information on Seacard Associates is available in its Form ADV disclosure documents available at advisorinfo.sec.gov.